Hey there, Singaporean investors. If you've been following Singapore's banking giants DBS Group, OCBC Bank, and UOB, you've probably noticed the mixed reactions to their first quarter 2025 results. While some analysts remain cautiously optimistic, others are concerned about margin pressure and economic headwinds. I'm Iggy from the Investing Iguana, and today we're going beyond the surface level analysis to uncover what's really happening in our local banking sector. The Investing Iguana has been ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, delivering quality financial content is what we do best. If you're serious about understanding the Singapore banking sector's transformation and what it means for your investment portfolio, this deep dive is exactly what you need. Now let's dive into the real story behind these first quarter 2025 numbers. Singapore's three major banks just delivered what I'd call a tale of two narratives. On the surface, you see mixed profit figures that might make you think these banks are struggling. But dig deeper, and you'll discover a sector in the middle of a massive transformation that could reshape how these institutions make money for decades to come. Let me break down the actual numbers for you. DBS reported net profit of 2.90 billion Singapore dollars, which was down 2% from the previous year, but up 10% from the last quarter. Now, before you panic about that year-over-year decline, here's the crucial context. This drop was primarily due to the implementation of the 15% global minimum tax, which increased their tax expenses significantly. When you look at their pre-tax performance, they actually hit a record 3.04 billion Singapore dollars. UOB delivered stable net profit of 1.49 billion Singapore dollars, essentially unchanged year over year, while OCBC reported 1.8 billion Singapore dollars, down 5% from the previous year, but up a solid 12% from the previous quarter. But here's what the headlines are missing. These banks aren't just maintaining their traditional lending business, they're actively transforming into diversified financial services powerhouses. The most significant challenge all three banks are facing is what we call net interest margin compression. Think of this as the profit spread between what banks earn on loans and what they pay for deposits. DBS saw their NIM dip slightly by 3 basis points from the previous quarter to 2.12%. OCBC experienced more pressure, with their NIM falling 23 basis points year over year to 2.04%. UOB managed to keep their NIM relatively stable at 200%. This pressure is directly linked to the lower interest rate environment we're seeing globally. But here's where it gets interesting. While traditional lending margins are getting squeezed, these banks are witnessing explosive growth in their wealth management and fee-based businesses. UOB just reported record net fee income of 694 million Singapore dollars, representing a massive 20% jump from the previous year. This growth was driven primarily by loan-related fees and wealth management services. DBS posted record fee income across their wealth management division, while OCBC saw their non-interest income grow by 10% year over year. This shift is absolutely critical for investors to understand. Wealth management fees are less dependent on interest rate movements and typically offer higher profit margins than traditional lending. Singapore's role as Asia's premier financial hub is creating unprecedented opportunities for banks that can successfully capture these fee-based revenue streams. Let me give you some context on the scale of opportunity here. Singapore's total assets under management grew by 12% in 2024 to hit 6.07 trillion Singapore dollars for the first time in history. That's a massive and growing market that our local banks are increasingly tapping into. As wealthy clients move money from low-yielding deposits into investment products, banks capture valuable fee income that's more predictable and resilient than traditional interest income. Now let's talk about what's perhaps the most compelling part of this story for income-focused investors. The capital return programs these banks are implementing are unprecedented. In just the first 5 months of 2025, DBS, OCBC, and UOB accounted for 77% of all share buybacks on the Singapore Exchange, spending a combined 712 million Singapore dollars. DBS led this charge with 277 million Singapore dollars in buybacks while maintaining their quarterly dividend of 60 Singapore cents per share. Plus, they added a special capital return of 15 Singapore cents per share. That means DBS shareholders are receiving a total quarterly payout of 75 Singapore cents per share. This level of capital return signals extraordinary confidence from management about their business transformation and financial strength. But let's not ignore the risks and challenges ahead. All three banks are prudently setting aside more funds to cover potential loan losses. DBS allocated 205 million Singapore dollars in general allowances. OCBC increased their total allowances by 25% to 212 million Singapore dollars, and UOB's allowances rose to 290 million Singapore dollars. This conservative approach reflects their concern about global economic headwinds, particularly trade tensions and geopolitical uncertainties that could impact Singapore's trade-dependent economy. The banks are essentially preparing for tougher times while executing their strategic transformation. Now, for my personal take on where these banks are headed and what it means for your investment decisions. After analyzing all the data and strategic moves, I believe the market is significantly undervaluing the structural transformation these banks have achieved. While analysts correctly highlight the net interest margin pressure and economic uncertainties, I think they're missing the bigger picture. The wealth management pivot isn't just a nice addition to their business model. It's a fundamental transformation that makes these banks more resilient and profitable over the long term. Singapore's unique position as the Switzerland of Asia is creating a structural advantage that could last for decades. With ongoing geopolitical tensions driving wealth flows away from Hong Kong and mainland China, Singapore's banking sector is positioned to capture disproportionate market share. This isn't a temporary trend. It's a structural shift in how Asian wealth is managed and deployed. The aggressive capital return programs we're seeing also signal management confidence that goes well beyond simple share price support. When banks are buying back shares at current levels while maintaining strong dividend policies, they're essentially telling us they believe their transformation story is working and will continue to generate superior returns. For Singaporean investors considering the banking sector, here's my investment framework. This represents what I'd call a selective buy opportunity, but you need to understand which bank fits your investment objectives. For growth-oriented portfolios, DBS stands out as the clear leader. They're executing the wealth management transformation most effectively, with record fee income and the most aggressive capital return program. Their estimated total yield of around 6.8%, combining regular dividends and capital returns, provides attractive income while you benefit from their business model evolution. For income-focused strategies, both OCBC and UOB offer compelling dividend yields. OCBC's focus on ASEAN markets provides geographic diversification, while UOB's strong regional presence offers stability. Both banks are trading at reasonable valuations while maintaining conservative balance sheet management. The key risks you need to monitor include exposure to potential trade wars, regional economic slowdowns, and the ongoing challenge of maintaining growth during interest rate cycles. But for patient long-term investors, these temporary headwinds might actually present attractive entry points. What makes this sector particularly attractive right now is the combination of defensive characteristics with growth potential. These banks offer some of Asia's most reliable dividend streams, now enhanced by unprecedented share buyback programs. At the same time, they're successfully transitioning to higher margin, more stable, fee-based revenue models. The wealth management boom in Singapore isn't slowing down. If anything, it's accelerating as the region's wealth continues to grow and seek professional management. Banks that position themselves effectively in this transformation will likely see their valuations re-rate higher as the market recognizes their evolved business models. Singapore's banking sector isn't declining. It's evolving, and the first quarter 2025 results provide clear evidence that this evolution is gaining momentum. The traditional banking playbook is being rewritten, and our local banking giants are leading this transformation rather than being victims of it. For those of you who found this deep dive valuable, make sure to like this video and subscribe to the Investing Iguana channel. We consistently deliver institutional quality research and analysis that helps you make smarter investment decisions. And here's something special for our most dedicated viewers. Our premium members get exclusive early access to all our videos, often a full week before they go public. This means you receive detailed sector analyses, earnings previews, and urgent market insights directly in your inbox, giving you a significant advantage over other retail investors. Think about it this way. For just $1 a month, Less than the price of a copy in Singapore, you get access to research-grade content that typically costs thousands of dollars from investment banks. You'll join Singapore's most informed investor community and get that crucial early edge that can make the difference between average returns and exceptional performance. Ready to take your investment research to the next level? Click the link in the description below to become a premium member today and join the inner circle of serious Singapore investors who consistently stay ahead of market movements. Remember, successful investing isn't about timing the market perfectly. It's about understanding structural trends, identifying quality companies executing successful transformations, and having the patience to let those transformations create value over time. Singapore's banking sector is giving us exactly that opportunity right now. Thanks for watching, and I'll see you in the next deep dive where we continue uncovering the investment opportunities that the mainstream market is overlooking.